You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Hi, how are you doing?
We're doing great out here on the wet coast. Our analysts worried another S&P 500 earnings drop is on the way.
Well, they've been downgrading the earnings so far this year. They've already cut them in half, and they're worried that the next quarterly earnings report is going to be full of disappointments because the dollar has been rising in value, which affects the earnings of the American corporations, that sell stuff overseas and whatnot. But the economy's been a little more sluggish than people have expected when it comes to things such as retail sales and so forth. So, yeah, they're just looking for a slowdown in earnings. But the thing about that is I really don't think most investors, well, there's two things. First, they're going to downgrade these earnings reports, the analysts will, before the companies report in the middle of the month. That way, when they do report, they'll be able to say that they've beat the estimates. And the people that watch CNBC and the financial media, that's what they'll see, news that the companies are beating estimates, and they will get very excited about that. So they'll work to lower their earnings estimates so that they can be so-called beaten and provide some additional excitement for stock market players who really don't care about this kind of news at all and are very bullish on the market, will not be denied what I think is really their final gamble when it comes to the stock market.
We've talked about manipulation of the markets. Is that part of the manipulation, changing the way the information comes out or how it's perceived?
Yeah, it is. It's something really that's been going on ever since I got into the stock market. I mean, it used to be that these earnings reports, a long time ago, I was talking like in the 70s and before that, weren't really that important, or that big of a deal for people. People really bought stocks thinking these are long-term investments, and they want to look for good balance sheets and the long-term growth of companies and so forth, and the price they're paying for stocks. But really, people are so short-term orientated that they obsess over these things, having to beat the quarter and beat the number, and it really doesn't mean anything, in the long run for any company if they beat the quarter or something. But people really want to trade on short-term news and all the excitement on TV, and it gives their TV something to report. It's not much to report if you just say, well, X company here is a good company and they're doing good things, but it leads to big problems because it can lead to this management of companies, because the CEOs are forced to obsess over these short-term earnings reports. And one result of that was the banking disasters of 2008, when so many so-called visionary CEOs did anything to so-called beat the number or have good earnings reports, even if it meant the long-run deterioration of the balance sheets of the banks and the companies they were overseeing. It's crazy. That's one of the big reasons why that whole disaster happened.
Is the solution to stop tying CEO salaries to stock prices and maybe put it on something else like long-term earnings or what kind of a debt load a company has?
Yeah, that makes a lot of sense to me. They definitely need to do something, but we need the shareholders to demand that. And, most of the shareholders for these companies, they're just trading the stocks. They don't care themselves about the long run. Especially now, the people who are really active in the stock market at this point, they're very bullish on the market, and and even though the valuations for stocks are high, the cyclically adjusted PE for the S&P 500 has only been higher than the current level twice, in 1999 and in 1929. And any other metric the market is overvalued. You can look, for instance, at the price-to-sales ratio, which is about double its historical average for the Dow Jones 30 stocks. People don't care about valuations or the future of these companies or what's going to happen. All they think is the stock market's going up, and I got to be in that. And if the market were to falter, then Janet Yellen will print money. And if I'm not in the market, if I'm a money manager, an institutional investor, or say an investment advisor, and you try to get out, you're in big trouble. For example, I can explain it this way. Say you're an investment advisor and you've got clients, that you're managing their money. If you decide the stock market's dangerous and, maybe it'd be best to do some selling, if you do that and the market were to continue higher, your clients will get very angry at you. And most likely, some of them will even just move the money to someone else. They'll find a broker, someone who will tell them that you're a fool to doubt the market and so forth. However, if you keep the people invested and stuff drops, you can just say, oh, well, everyone else is doing the same thing, and things will just go back up, and don't worry. And that's what people want to hear. So it's really built in to the market for people just to be bullish all the time and not really handle money in a careful manner. And we're in a moment, I'm saying all these things because I believe we're in a moment where people need to be very cautious. I mean, I'm talking about the stock market being overvalued, but it's more than just that. The way I interpret the market is you're either in a bull market or a bear market or a transition period in between. And I think we're in a transition period where we're topping out. These tops can happen in a few months or a year, but they're characterized by wildly bullish sentiment, which we have, the high valuations, but also an internal deterioration that takes place inside the stock market where most stocks no longer go up with the market, and that's actually started about last year in July. But there's a big illusion going on. This is one of the things I really like people to think about, that there's a huge illusion going on in the stock market with the people in it. And what I mean by that is we've been going up for 6 years, and the NASDAQ went above 5,000 for 3 hours on March the 2nd, I believe it was. And when that happened, there were all these stories celebrating that as a great milestone and giving people the impression as if huge amounts of money were being made on that very day, which wasn't really true because all the money had been made over the past 6 years, but the milestone being broken just excited people. Well, the market pulled back down immediately, and then it rallied back above 5,000, this time for 3 full days. Couldn't hold that level, and now we're having a bad day today as we do this interview in the stock market. But the point is that level itself is just capturing people's imagination, and when you turn on CNBC or these channels, no matter what happens that day, usually they pick out some crazy stock that's gone up a whole lot to really talk about and hype you up. So I was watching Jim Cramer last night, and he's talking about some crap company called Lululemon and hyping it up. Well, about a year or two ago, he would be talking about Ford or General Motors or, IBM or whatever, some household name, real solid company. But those companies aren't the ones going up. It's just a few silly stocks and biotech stocks that they look really shaky, but they were doing well for a few weeks. But here's the illusion, or the reality. The reality is the market is flat year to date. And almost everyone can look at I just ask the people to listen. If you're listening, do this. When you get your statement, look at it this quarterly statement for your brokerage account, and see if you're up year to date or down year to date. Because I can pretty safely assume most people are down just a little or barely up at all. And while that's the real reality, everyone's hyping this market to the moon, and yet people aren't really making money. Then that's characteristic of a topping market. And if you understand that, then bear market is going to follow, and you can prepare yourself mentally, take some steps to do that, to be okay, reposition yourself, make sure you have a more defensive allocation, and don't get caught up in the crazy hype going on, because it's not reality. If you just look at your brokerage statement, you'll know this is not a market where people are making fortunes this week or this month or so far this year. All the gains have been made in years before. It's done. It's over. You know, if you want to make money, you got to do something else. You can't just buy into this stuff and just believe it's going to keep going up forever.
I think 10 years ago, we didn't have all of these business television channels to have yelling sellers, like I call people like Jim Cramer, urging you to get out there and participate in the stock market. Now everybody who's into the stock market is tuning into all these channels. Has that changed the way business is done?
Yes, it has, and I know I've mentioned his name here, and it sounds really hard on him, but I want to be fair to him in one aspect of this too. It's not necessarily his fault, because what happens, it's just like the investment advisor I was talking about scenario. If you're on television, let's say you have a financial channel, people tune in because they want picks. They want stock picks. They want to make money. So if Cramer all of a sudden just said, stop doing this, or be cautious, he would probably lose all his audience, or at the very least, the advertisers who would be very angry because they have brokerage houses and mutual funds or whatever that are advertising and funding the whole channel, really, and they would be furious. So he's kind of trapped. I mean, I don't know if you can, have a different message than the one he has, or all the other people on these channels too, for that matter. It's not just him. And he seems like a nice person and so forth. But it's just a crazy system. And it's okay when the market is starting a bull market, and you can think, well, we can go up here for a couple of years. Yeah, it's great if people are helping people get into the market and recommending this and that stock and so forth. But this is like 2007 or 2000 or something. Not to say that the banking system's crashing or something like that, but all bull markets come to an end, and it's not the end of the world. And if you have a bear market for a year or two, but this isn't the time to be on margin and just chasing stocks and going crazy. And I think people need to be allocated in a defensive manner, have a little bit of cash reserve, so if the market does falter, they can, buy at lower prices and take advantage of lower prices and not just be a forced seller or something. And then commodity, and usually, something does go up in bear markets, so you can look for alternatives to the U.S. stock market. And I think gold and commodities will in time, turn up and do really well. It actually be helped by bear market in the stock market, because the bond market is already, the interest rates are at zero, and it's hard to think that you can just keep using bonds as a safe haven in the same way you could have done in 2008 or 2000. They just don't have that much upside. So people, if the market does weaken at some point, they'll be looking for an alternative to zero, or to zero yielding CDs and bonds, and that can help gold do very well. So I think if people just did a simple thing of, having 10% in cash and 10% in gold, they would, and even, and keep the rest of their money in the stock market or whatever. Most people don't like the idea of selling anything, so I'll just suggest 10%, sell 10%, put 10% in gold. Just do that. You can do fine. You probably even make money over the next couple of years and be in a fantastic position, but everyone just wants to be all in these crazy stocks.
Let's play double or nothing every day.
Yeah, just about it. And I've seen this before. I mean, in 2007 and 2000, when the market, we were not at that point yet, in a bear market yet, but when a bear market comes, most people just, watch it or don't pay, they just kind of don't look at those brokerage statements until one day they look at it, and then they're pretty much disgusted. But the active traders, they tend to just keep trying to guess the bottom all the way down, or they see a rally like we had the other day where the Dow was up like 250 points, and they think that's the bottom, and they buy it, and the next day everything just falls to pieces. You keep doing it over and over and over again. So it's a tough, I'm not going to kid people. This is not an easy market to make money in right now, and And, things will change in time, and there'll be opportunities to buy stocks. But and the seasons change. We're entering springtime, and, it'll be summer in a couple months, and bear markets usually just last 6 to 8 months, when they get going or whatever. So just step away from this thing for a little while.
We'll have more with Mike Swanson right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mike Swanson from WallStreetWindow.com. Mike, you were telling us that investor intelligence polls are showing something very interesting or unusual. What are they showing?
Well, there's two polls. There's one, American Association of Individual Investors, and there's one called Investors Intelligence. And I don't really pay any attention to the first poll because it swings so wildly. It's polling individual investors, and their emotions tend to change week by week, so it doesn't really necessarily mean anything. The other poll, though, is really important. It polls investment advisors and newsletter writers and analysts and so forth, and asks them, are they bullish or bearish or looking for a correction? And historically, important bottoms have come to the stock market when there's more people saying they're bearish than bullish. It's a contrarian thing. What happens is people tend to get bearish on the market after they sell, and they're bullish when they're long. So important tops have also come when people are very, very bullish, but they don't seem to time exactly with the market. I mean, they can be all these tops. The topping signal in the poll can be off by 6 months or so. But what's crazy about the poll is that, according to it, 14.1% of the people say they're bearish on the stock market. Well, you got to go all the way back to right before the 1987 stock market crash to find fewer bears than there are right now. I've been doing this since the mid-'90s, and there never has been as few bears in that poll during the time I've been in the markets as there are now, which is pretty remarkable. It just shows you how lopsided people's thoughts are in regards to the stock market, and it's, from a contrarian standpoint, it's a big warning sign.
How is the middle class holding up right now?
Well, it's interesting because the middle class of the United States is since 2008 it has been shrinking. However, what's happening is that while the middle class is shrinking, both the upper income brackets or wealth brackets and the lower wealth brackets are growing. So people lose their jobs, and when the market fell in 2008, many people needed the money to retire, and they sold and never got back in the stock market and so forth. I mean, as a whole, most Americans have less wealth than they did in 2007 and 2008. But those people, and I know lots of people who've lost their jobs and, aren't doing as well as they did in the past. But all these people I know, and I think it's true of just about everyone in these situations, has adjusted to that in one way or the other. Life goes on, you do what you have to do. However, the other upper wealth bracket is a different story. These people, there are people who've gone from the middle class up into the upper wealth bracket, and the way most of these people have done that is they did not sell in 2008 and 2009, and in the year or two that followed, when a lot of people did. They remained steadfast and strong in the market, so they benefited from this bull market rally, and they have grown in their wealth. The problem is these people, very few of them are going to do anything if another bear market comes, or sell, or anything at all, because they've convinced themselves they did the right thing by never selling. And a lot of them, their identity is caught up in watching their brokerage account and imagining that it's going to double or triple or something, and it's just a part of who they are, and they're devoted totally to the market and the belief that it can go up forever, and if it falters, the Fed will print money or do something to make it go up for them. And these people, I think, are actually the most vulnerable segment of society now, because everyone else has tightened their belts and adjusted. These people have not. And, that's just the way it is. So the funny thing is, it's not so much the middle class that's vulnerable now. It's already been hammered and shrinking, and people in the middle class know they're in a difficult situation, being battered by old size, whether it's higher taxes and seeing their health care insurance go up, the threat of unemployment. It's a tough life, but what's the upper income wealth bracket going to do when they see their stock wealth get vaporized over a couple of years when the next bear market comes?
Mike, you have some interesting views. How can people get your newsletter?
They just go to my website. It's Wall Street Window. It's all one word. Just type that in on the internet, wallstreetwindow.com, and it's all right there. It's free. There's a free email newsletter and a private pay area, but there's plenty of it for free that they can get.
Mike, thanks a lot for chatting with us.
Thank you.
My guest has been Mike Swanson from wallstreetwindow.com. You're listening to HowStreet.com radio on TalkDigitalNetwork.com. Find us on Twitter at TalkDigitalNet, and you should check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.